Welcome to This Explainer. Today, we're diving straight into a massive paradox at the heart of Europe's largest economy. You see, Germany produces incredible engineering, top-tier management, and some truly groundbreaking startups. But historically, right when those innovative companies reach the late stages of growth and are ready to take on the world, they hit a brick wall. The funding just abruptly stops. So we're going to explore exactly why this missing money problem exists and how the state has quietly stepped in to rewrite the rules of venture capital entirely. To really grasp the scale of the solution here, consider this massive figure, 5.8 billion euros. That's the staggering size of the European Fund of Funds facility for German venture as of January 2026. A number like that proves that public money is no longer just a temporary band-aid or some quick rainy day intervention. No, it has officially become a permanent structural pillar of the European venture landscape, and it's fundamentally altering how companies scale. So here is our roadmap for today. We'll start with the missing money problem, then look at how public VC actually works, dive into market distortion by design, cover the true structural fixes we still need, and finally wrap it all up with a founder's playbook. Let's jump into Section 1, the missing money problem. Great startups, empty pockets. We need to address a massive misconception right out of the gate. For years, people just assumed that maybe German companies weren't scaling well enough to attract big checks. But the reality? It's entirely different. This is a classic market failure in capital allocation. On the demand side, the tech, the unit economics, and the talent are absolutely world-class. The shortage is entirely on the supply side. Think about this. There are literally trillions of euros sitting in German pension and insurance vehicles. But those institutions are bound by incredibly strict prudential rules designed to protect retirees' savings. Because venture capital is deemed too risky, that institutional capital legally cannot flow into it. The money is absolutely there. It's just locked tightly behind a regulatory vault. Moving right along to Section 2, how public VC works. The state as an anchor tenant. Because to unlock that trapped capital, the government had to step in. But they didn't just blindly write checks directly to founders. Think of it like a brand new shopping mall, where the government acts as the anchor tenant. By committing a massive initial sum, like the 1 billion euros used to launch the German Growth Fund back in 2023, the state validates the space. They make that crucial first commitment that makes a private fund viable, which gives private investors the confidence to jump in too. And the demand? It is off the charts. With over 80% of that initial billion deployed by late 2025, it's crystal clear how desperately the market needed this cornerstone capital to get moving. Now, the way this money flows is actually brilliant. The state delegates the incredibly difficult job of picking winners to private managers. Why do they do that? Well, to avoid the massive trap of political lobbying. If politicians invested directly in named companies, it would inevitably invite regional pressure, favoritism, and let's face it, a refusal to pull the plug on failing startups. Instead, the public vehicle provides the heavy financial commitment, but the private fund manager, whose own skin and reputation are fully in the game, handles the selection and the pricing. It's a pretty perfect marriage of public scale and private sector discipline. Which brings us to Section 3, market distortion by design, intended consequences. Let's be real, you simply cannot inject billions of euros into a private market without changing its gravity. So it begs a pretty huge, highly debated question. Does all this state intervention actually ruin the natural pricing of startups? Critics frequently raise the alarm here. They worry that public money might crowd out private investors, or even worse, prop up zombie companies that wouldn't survive a single day in a truly free, competitive market. To prevent that kind of toxic market distortion, the government strictly limits its risk by investing pari passu. That just means they invest on the exact same economic terms alongside private limited partners, the institutional investors who normally back these funds. They aren't handing out cheap subsidized money. However, they are intentionally inflating overall fund sizes. By anchoring these funds, they allow managers to raise much larger pools of capital. And the mechanical reality here is that larger funds invest in larger rounds at higher valuations. So is the market distorted? Absolutely. But if your core diagnosis is that European funding rounds are way too small compared to their US or Asian competitors, well then this distortion isn't an accident. It's the exact desired effect. Now, this heavy government involvement takes on a totally different flavor when we look at the booming defense technology sector. Here, thanks in part to the 2026 defense strategy, the state isn't just an investor, they're acting as a direct customer. This gives founders incredible revenue visibility through framework contracts. But of course, that public money comes with heavy strings attached.
strict export controls limit who you can eventually sell your tech to. Plus, a lot of private venture funds still have legacy vice clauses in their contracts that outright forbid them from backing defense startups. It creates a really fascinating, high-reward, high-complexity microclimate.
All right, Section 4, the true structural fixes, beyond the public bridge. Because as helpful as this public capital is, we have to acknowledge that it's just a bridge, not a long-term cure. If we want to create a venture ecosystem that doesn't rely on state life support forever, 3 massive regulatory shifts have to happen. First, those conservative prudential rules we talked about earlier, they absolutely must be reformed so domestic pension funds can finally participate in venture gains rather than just sitting on the sidelines. Second, we need much cheaper, less burdensome routes for mid-sized companies to go public. Right now, European exit markets are simply too shallow to support massive public listings. And third, the tax treatment of employee share options, or ESOPs, has to be overhauled. Startups can't always match giant corporate salaries, so they need appealing equity to incentivize top-tier talent. Until these structural cracks are actually fixed, the government is going to be forced to keep writing checks. And finally, Section 5, the Founder's Playbook, navigating the landscape. If you're a founder watching this explainer, we need to translate all these massive macroeconomic shifts into actionable, ground-level strategy for your business. First up is the corporate VC hack. Germany's industrial giants have massive venture arms that offer unparalleled access to testing sites and commercial validation. It's super tempting, but beware. If you let them lock you into an exclusive commercial deal as a condition of their investment, you become entirely dependent on them. When you go to raise your next round, traditional VCs will run for the hills because your startup basically looks like an outsourced R&D department for that one corporation. So the golden rule? Take their equity on standard terms, but always keep your commercial partnerships strictly separate and non-exclusive. To really thrive in this current ecosystem, you've got to implement 3 tactics immediately. First, build a cap table with international investors who have the dry powder to actually lead massive Series B and C rounds, because domestic German syndicates frequently hit a funding ceiling pretty early on. Second, structure your legal and corporate setup to be attractive to those international investors right from day one. And finally, plan your endgame early. Because the IPO market is so shallow, the default exit path is usually a trade sale, getting acquired by a larger company. If your ultimate goal is true standalone independence, your financing strategy must be radically different from the very beginning so you don't get forced into a premature acquisition. I want to leave you with a bit of a provocative thought. We love to credit brilliant founders when startups succeed, and we're quick to blame them when they fail. But as we've uncovered today, sometimes the biggest hurdle has absolutely nothing to do with the technology, the team, or the product market fit. Sometimes the silent killer of innovation is just a stack of boring, invisible prudential regulations sitting quietly in the background, dictating exactly where the money is allowed to flow. So look around your own local ecosystem. Are structural constraints dictating your ceiling? Thank you so much for joining me for this explainer, and I hope you never look at the flow of venture capital the same way again.